In this presentation, we're going to address what happens when an income note is showing a value above its par value. This is also known as a note getting called, and why it can impact a long-term income strategy. First, it's essential to understand that the goal of an income-oriented structured note is to generate consistent income. They are not designed for growth. Income notes usually pay monthly or quarterly payments. Most income notes typically have a level of principal protection built in. They are not designed to go up in value like a stock. Let's take a look at this hypothetical income note. This note has a 24-month duration, a coupon rate of 24% per year, paying 2% per month. The blue, green, and orange dots represent the underliers. The note has a coupon barrier level of 30% and a principal barrier level of 30%, represented by the red line on the graph. However, notice on the graph that there are only 7 months of payments. Remember, the goal of an income note is to pay consistent income for the full duration of the note. In order for this to occur, the underliers each month have to show a value below the original par value, but above the coupon barrier level at each month's valuation date. But what happens if all of the underliers are above the par value on valuation date? Notice on this graph that all the underliers are performing well and all are above the par value on month 7. This can trigger what's known as a call feature from the issuing bank. In this example, we're showing what happens when an income note gets called early, meaning it's redeemed by the issuing bank before the full term ends. As a reminder, this note originally had a 24-month duration, but it gets called after only 7 months. Here's how it works. Each dot on the graph represents one of the underlying equities. As you can see, all the underliers are performing well and staying above the black line, which is the par value, and above the red line, which is the 30% principal barrier. Because of this scenario, the note paid its monthly coupon of 2% on month 7, and the issuing bank calls a note. That means they pay out the full principal plus the final coupon, and the investment ends early. In this example, the client received a total of 14% income and a full return of principal on month 7. The table at the bottom shows 2 transactions on this call date, one for the income payment and one for the return of principal, in this case, $2,000. Being called early could be a good outcome. It could mean the investor received steady income and got their full money back sooner than expected. However, the principal return to the client would need to be invested into a new strategy to continue working for the client. Called notes are redeemed early by the issuing bank when underliers are performing above par value. Investors receive all earned coupons up to the call date plus full return of principal. Early calls are a positive outcome, often signaling strong performance of the underliers. The total income, however, may be less than the full term potential, but with a quicker return of capital. Very important, once a note gets called, you must reinvest the money to keep it working for you.